Well, ladies, hi everybody. We're so happy to be here. Either if you are watching us live or you're going to watch recording later again, we'd love to have you here. I'm Miri Cordaro. We have Carolyn Blazo. She's usually on the podcast with me, and we have a guest today. We're so excited to have Deb here with us. She have a lot of experience and what we're going to talk, a lot of things to bring to the table. So how about Deb? You tell us a little bit about yourself.
Sure. Well, first off, I've been married for 48 years and a half. Um, a grandma of four, a great grandma of one, and my family and faith are very important to me. I started in the insurance industry about 21 years ago, and it gets better all the time. I love it. I love helping people. I love the visions. I love just being there, helping people reach for their goals. Um, it is very important to pay yourself first, beyond anything else, because if not, 100% you will regret it when you get my age. Oh, you wanna make sure that you pay yourself first so that you can have a great retirement, a great future, do the things with your kids, grandkids that you want to do. Our industry is ever changing.
Yes.
When I first started, I was selling whole life, and I am no longer offering whole life because I found something better. Just like, does anybody use the BlackBerry phone or flip phone anymore? Things evolve. So I use the Index Universal Life that offers so many functions, so many benefits and features, tax free, retirement growth. You can use it for enhancing, um, use it for a vehicle where you want to invest greater, like real estate. So it's just exciting. I love it. I love helping people. If I'm always here for any questions, anything, because I just love helping people.
That's awesome.
Yeah, I was going to say, and also for our listeners, Deb, Mary, and I all work together in educating others with strategies using an indexed universal life insurance policy. And I think the three of us agree that in our day and age, with so much innovation happening, it's worth all of us really looking at what are options that are out there. There isn't just one option for retirement planning through your company. I thought it would be interesting. This morning, I was looking up the numbers of what are the concerns that people have out there. And it was really interesting. One of the studies that I read, which stated that 79% of Americans are worried about retirement, which is up from 2020 when 67% of Americans were worried about retirement. In other words, it's not going the other direction. That people are confident about more and more confident about retirement, and that part of that is not just concern about retirement, but they're concerned that they won't be able to achieve financial security in retirement. Like over half the people that were asked that question. And part of that I was noticing today was that because there's so much uncertainty regarding retirement planning, there's a big push to bring back pensions for people. And it's not necessary, and pensions really are an insurance plan. That's the company takes out an insurance plan on their employees. It also is telling me that Americans are looking for other people to solve that problem for them of their uncertainty of why they're asking for pensions. And then the other part of it is that I was reading a Vanguard study where not all companies that offer a retirement plan or a some type of 401k or Roth IRA plan, not all of them even have counseling that goes along with that uh, on the plan that they're being offered, and having some real support in answering questions to go along with that. And what was especially astonishing to me was that those companies who offered assistance in understanding that more, only 10% were taking advantage of that opportunity, as they called it, to the service, the participant service of those participating in the company plan, to really understand more about it. So my takeaway from all of that is this concern that the three of us have, that people aren't research and wanting to understand more about how to prepare for retirement. And they're still counting on other people to take care of that responsibility for them.
I found it so odd that it's actually like that. I found it very interesting that people would leave their most important part of their life in somebody else's hands without really actually understanding what is in stake. It just doesn't make sense. I mean, I left all my financial decision to my husband, which I don't think it's a good idea either. I think it's a very, very now after all these years that I understood that it shouldn't be that way. I should really understand enough so I can even suggest help. I think it's very important that everybody understand financial and how what's in stake, because we all want to be living a better life as we get older and do really what we want to do. So what do you think, Deb, about this, people leaving their life most important decision to other people?
I agree. I run into so many all the time that have a 401, and I say, how much do you have in there? Oh,
I
I
don't
don't
know.
look at it. I was like, whoa. And it is, they don't look at it and they don't know what they're invested in within their 401k.
Mhm.
It's taking it that they're just going to throw that money because the company is matching.
Yeah.
Not realizing, and many are not aware of the 4% rule when they go to pull it out at retirement. So if they have $1 million in there, the 4% rule, they can only pull out
40?
1,000.
40.
Uh,
That's
Well,
before
and even
taxes.
that study I was referring to earlier about only 10% of people really taking the time to learn about their company plan, it was saying, well, no, actually, it was a different study, but now it's not 4%, it's 3.75. They're finding that 4% is too much. And maybe, Deb, you can explain a little bit more about what that 4% rule really means.
Yeah, so they want to, because you're at risk in the market, they want to make sure that you have enough money that's going to last your lifetime. So they feel that if you pull 4% or 3.7% out annually, that you'll be okay for the rest of your life. When we have down markets, they lower that amount. I've seen it as low as 2.8. So it all depends on where the market is, what you're invested in, because as you get older, you go more into bonds, into safety, because you can't afford that loss. Because the one thing we as seniors don't have on our side is time.
Right. Yeah.
So when you're young, you have the time on your side, and you can be more aggressive, is what they're saying with stocks versus less bonds. But the many people are not aware of that until they do go to retire, and it's way too late.
Yeah.
Way too
Right.
late.
Right. So 4%, and then the other part of that 4% rule is, it would be a 30-year retirement, or well, really till age 90. So
Yeah.
let's say you retire at 65, it's really only a 25-year, that 4% should only last you,
Yeah, you
will
can
only
outlive
last
it. You literally can outlive your money, and
you. Yes.
that's a scary thing, And then yeah,
And then you
I know.
get to pay taxes as well.
Yeah, that's on top of it. It's because it's not tax free. I mean,
Right.
most of it. We have Roth that it is, but still,
Right.
how many people have it and how much they have it, and it's not nearly even enough to even think about
Well,
it.
and not all companies offer the Roth option. That
Uh-huh.
was
Right.
part of, or no to ask for the Roth option,
Yeah. Hmm.
because a lot of the information that they're given is it's better to not pay your taxes now. That will be an advantage to you. But the difficulty with that strategy is that you still are going to have to pay taxes. And now you'll pay the taxes in your retirement when you're really, that's one of the uncertainties. Who
Hmm.
knows what your tax uh, burden
Well,
will be at that
well, it will
time?
be higher for sure.
Yeah, and I was going to say, if you're paying taxes on Social Security, you're paying taxes on your retirement income, it keeps reducing. And now, if it's not for the 4% rule and it's the 3.75, like all we've covered so far is how to keep minimizing
It
what
is.
you're going to, and it's actually not funny. I shouldn't be
No, it's
chuckling,
not.
but
Taxes is actually, I think we taxed on our stuff probably 7 times, which is really sad. We continually, they're taxing everything. Like, you
yeah.
would think.
So Deb, tell us how, so where the three of us met, and because like I never even considered being in the insurance business. I've been in the insurance business 6 years now because of what I was learning. And Miri came also to
Here I go.
life insurance being something she was passionate about too, just in the last couple of years. But you've been at this even longer than we've been at it. But what is it about the IUL that we educate people about today that's brought us all three to meet doing the same thing?
Hmm.
Absolutely, absolutely. Well, we work with the Index Universal Life. That is, we do max funded, so
Hmm.
the least amount of life insurance, and life insurance is important.
Absolutely.
You don't want a GoFundMe page out there, so life insurance is important. We pay insurance on our property, our autos. Why not? Why not our life?
Yeah.
But this we focus primarily on your future.
Hmm.
So with the Index Universal Life, the maximum is going toward your future, the minimum going toward the cost of insurance and the cost within. And then we have the MPI strategy where we apply leverage within the policy,
Hmm.
where we're able to enhance our acceleration at the third policy year over and over and over again, which I've done side by side illustrations with many whole life index universal life policies, and side by side the growth potential can be much greater that you would have with the extra acceleration that you can use for real estate or whatever you choose to use it for. Build that reserve within life insurance to have all the features and benefits so that you can go out and invest and get double, triple digit returns.
So, so do I hear that we can use it while we alive? That's what you're saying?
Absolutely. Living
Mhm.
benefits. Absolutely. You can use it while you're alive, and it is not taxable under the tax code 7702. So many people really like that aspect where this portion of your portfolio is tax free. So you're not
Mhm.
going to have to worry about that.
Wow.
I
That's,
I was going to add as well that really any kind of investment in the stock market, in the S&P 500, there are the highs, there are also the lows, and
mhm.
throughout that, the average growth that people have in that kind of a vehicle is around 7%. And I was visiting my mom a few years ago, and she had just gotten her statement from her advisor for her stock portfolio. And she handed it to me since she knew I was in that industry. And she goes, Carolyn, why don't you just read it and don't tell me any of the bad news about what I was losing? And I thought, this is a real problem, as particularly for women, leaving our education and understanding of our finances up to other people. Oftentimes, the spouse passes away first, and then we're left with handling the financial affairs, and it feels really overwhelming and burdensome to so we put all of our trust in someone else to handle it for us. And
Mhm.
thankfully there are those people, yet it isn't necessarily so difficult to understand what's happening. But explain to us, Deb, why we're also so passionate about the IUL and the fact that there's a zero floor.
Absolutely.
Mhm. Yeah.
Absolutely. We are not in the actual market, but we're linked to the S&P 500. So when the
Mhm.
S&P 500 has gains, you get gains. When the S&P goes down, you don't make anything that year, but you don't lose anything. So it's kind of like a stair step effect. When the
Mhm.
market is going up, you're gaining, and it over the years, it's worked out very well for people with the growth using it. So when the market goes down again, you don't, it's sleep insurance. You don't have to worry about, oh, is the market going to dip? I heard on the radio that it's going to dip. You don't have to worry about that with this.
Well,
Mhm.
especially now that everyone talks about we have been in this bubble. We've been in a strong economy the last little bit, even though we've had a lot of inflation. We haven't really had one of those serious down markets for quite a while. That all and I like what you said of just that sleep well at night, just knowing that whenever that moment is going to happen, that we're not in a place where our money is at risk from having that happen to our account for the future, which is, if you have a traditional plan, that is part of what's going to happen. And I'd like to also explain how time is so important, to recognize time in that equation of loss and gains.
Think back to 2008 when the market went down. It took people on average 7 to 13 years just to get back even to where they
Mhm.
were. So
Yep.
those people totally lost 7 years. Okay. It's gone. Time is one thing that we cannot get back in our lives.
Mhm.
So when you have your money in a vehicle that can continue to grow and you're not losing when the market goes down, it's just that security of knowing it's going to be there when I need it the most. And
Yep.
that's in retirement.
Mhm.
So you're just building that up and not having to worry about that. Um, so it is a phenomenal option
Mhm.
for anyone looking for safety.
Yeah.
Mhm.
It's not only you
Safety
have
and security. Yeah.
it's not only you have to catch up, so you have all that now this hole that you need to fill up. You miss the growth that you could have had in all those years. So it's like
Absolutely.
you losing twice. It's not only once. It's not only just catching up. It's like that growth, that compounding. You miss that compounding. It's
You are
done. It's
correct.
gone.
You
It's
are correct. Yes.
it's painful just the thought of it. I'm in pain. Like, oh my
It's
gosh,
it's
I don't like
it's and the closer that we get to retirement, the 5 years before and the 5 years after are the
it.
most critical that you don't want to lose if you want your money to last you your lifetime or when
Absolutely.
you're in the market. With
Right.
this type of vehicle, it's not, again, it's not an issue. Um,
Yeah.
Yeah. And I was going to say, I think one of the things that uh, came to my understanding as I 15 years ago went on this journey of what did I miss? What did I miss teaching my children? And what did I miss about really being an asset to my husband in deciding our our financial strategy going forward, so we could be where we wanted to be financially? And that was this compound interest. It isn't something that we're unfamiliar with of hearing.
Mm-hmm.
I think the difficulty has been knowing, is it really happening for me with where I have my money?
Mm-hmm.
So address that as well, Deb, of what is the power of compound interest when you have no risk in the market.
Mm-hmm.
so it can double quicker because you're at no risk. You don't have to play that catch up game. When you pay yourself first and work on that aspect, it is going to continue to climb over the years, reach your goals that much quicker. To be able to do your real estate adventures, whatever adventure that you choose to do towards your future.
Mm-hmm.
Yeah, and so I'd like to address that as well. If the IUL, the one that we are particularly passionate about, this index universal life policy, where you're saving your money, you have the cash value, you have the life insurance component. The beauty also is that you have accessibility to that savings that you're building, both with your own money and also the leveraging with using the insurance company's money, which allows you the opportunity to then access that as well. So tell us a little bit about what is meant by accessing your savings for future investment opportunities.
Absolutely. So you build up and you build up your cash value and you have accessibility to your cash value. The longer you let it grow, the more accessibility that you have. We with using the tax code 7702, we're able to pull it out and do a loan within the policy tax free. And you put it in your real estate, you buy a vehicle, you do whatever you choose with it, throw it back in, rinse and repeat, continue to add more by compounding. So it is just a process when you commit to paying yourself first and not looking back. I can't tell you how many people I've ran across over the years that have said, boy, if I would have only done this. And then, I've had people say to me, well, next year I'll be in more of a position to do so. And I said, will you?
Yeah.
Because next year something else happens.
Absolutely.
And I know that from personal experience.
We all
Right.
go through that.
The longer you live, the more things happen that we could have never imagined or dreamed would be part of what we're facing in life.
Because
Yeah.
it's never a good time to do really anything. You know what I think about it when people say, "Oh, I'm going to have a baby when I'm ready." No, you're never going to be ready. You're just not going to. You can't. Nothing can make you ready. So, but understanding that commitment, and I try to drive it so hard on my children. I think half of them understand, and some stuck. It's like it's phenomenal to understand how important it is to commit. I think, don't you think it's probably the hardest things for people is to start? I tell people just start, because when you take the first step, then it's become easier every time you take the step and commit to it. Commit, because you're committing. I mean, to me, it's like you're committing to yourself. What best can you do if not commit to yourself? You know?
Yes.
So,
Well, and I would add to that as well with just the many people that we talk to. I'm always so impressed that when the parents get an understanding of the power of this for themselves, they think, "Oh my goodness, if I start my children with an IUL policy when they're so young, they you can start with $100." And over time, usually our clients, what would you say your average client age is, Deb?
I would say 30s to 40s.
yeah, that's what I think.
Yeah, and that I would say the same thing. I mean, I do have some that have just graduated from high school that have started their own policies, and some of what they tell me is, I don't want to end up like my parents.
Yeah.
Like, really is their motivation is they saw the stress of money in the lives of their parents and they refuse to go down that same path. But even at 30, imagine if they would have had something started by the time they were first born. And we talk about compounding being every 7 to 10 years, whatever you have been
Double.
contributing has the potential to double. So imagine 30 years, that's at least 3 compounding cycles, maybe even 4 compounding cycles, versus just getting started at 30. With that savings, you're required to contribute more per month, uh, just for that minimum amount of death benefit. But we're grateful at any age that people are coming to us and saying, "Tell me more." Uh, I would also add one of the things that we didn't discuss yet is that looks like Mary's going to madly get her computer plugged
I
in.
know, I'm so
So
sorry.
we
Because
don't
it's
lose her.
video, it looks like it's heating it up. Okay.
Yeah, but I was going to say the other part of what we're talking about too, which was part of my journey, was how can my money work for me in more places than one? For example, either it's in my checking account, or it's in my 401k, or it's in my life insurance. Whereas what we educate people on is your money has the potential of working for you in 3 different ways at the same time. Do you want to elaborate on that a little bit, Deb?
Sure,
Yes,
sure. So
that's my favorite one.
you start your policy, and then, as I had mentioned, at year 3, we're able to go back to the insurance company and ask for an increase in death benefit. We borrow that amount, put it in as premium. So that money is working for you as well as your money. So the insurance company plus your money, then you can borrow it out for when you build it up for real estate or whatever adventure that you have. So the triple compounding make your money work for you in many different ways. That's how the wealthy get wealthy. Is OPM, other people's money.
Exactly.
So that's what we help educate you to do, is to your money plus the insurance company's money plus whatever your endeavors are, and let them all continue to compound for you over your lifetime so that you can create a legacy for your heirs down the road.
Right. And it's all tax free. That's the other part of it. We help manage that so that you're never in a taxable situation. And I was also going to add as well that even if, unlike a bank, let's say you had $10,000 in the bank and you wanted to do something with 5,000 of that amount of money. So you take it out of the bank and now it's just in that other thing that you're investing in, or for whatever purpose you had that $5,000. But with life insurance, where you're actually going to use the insurance company's money to go and do the $5,000 whatever you want to do. Meanwhile, you'll have a placeholder, kind of like a lien on your cash value, where you're also can earn money on that loan within that cash value. So you have everything you ever contributed. You have those policy loans Deb was talking about that are possible, but you also have your loan that you're using the insurance company's money to go do that other investment opportunity. That can earn anything above the cost of the loan, which currently is at 5%. But any gain in the market up to a cap currently of 10%, that you can earn additionally. So your contribution hasn't disappeared from your cash value. If you've put in 10,000, it will always be there. Plus, you can earn money in that investment that you were taking money out to do. And I have many of my clients doing that very thing, is maximizing their initial contribution is getting the growth in the market. Their money is protected there from loss. They've gone and purchased real estate. Meanwhile, there's a loan for that amount that they have used for their real estate that's making money, plus the real estate is making money. There's nothing else out there where it's all in a protected environment. There's potential for growth in multiple ways. Those loans don't necessarily have a time frame in which they need to be paid back. To keep that revolving door going, you would sell the property, make some money on your investment, and continue to put that back in, because what we're doing is wanting a strong foundation for the other investments that you'll continue to participate in throughout your lifetime to create residual income, greater growth for future retirement purposes, but all in a protected environment from loss in the market and that potential for compounding. Anything you want to add to that, Deb or
It,
Miri?
it, you are 100%. I mean, planning is crucial in any aspect of life, but especially building a foundation. And that's where this is. It can build in security while you're building for other adventures. And with the loan from the insurance company that we put back in as premium, whatever you're contributing, it can be matched. So
Yeah.
say you're doing 500 a month, it's the same thing. So the more that you can pay yourself first, the
The more they,
more that you will be able to receive and help accelerate your compounding over the years.
yeah,
Um, even by putting in a lump sum of money up front so you can get accessibility quicker to your real estate adventures.
yeah, yeah,
And I think, Miri, you've experienced this with your kids. Our kids, they just want to save so they have their money ready to go at the next thing instead of wanting to save and you may not be using it for a year or two. Is it worth it to start a life insurance policy and just have your money sitting there waiting for you for the time you're going to use it versus the bank?
absolutely. I think so. Don't you agree, Deb? I
100%.
mean, because even if you think that you want to use it in a year, I know my daughter been thinking about using something for 4 years now. Just imagine if she started 4 years ago, she would be far more down the road where she wants to get than she's still young, all right? She's mid-20. However, I think she's finally, like, this is just example, is she finally, I think, getting it. She said, oh, she says to me, oh, she said like, oh, 3 times, because I think sometime it's finally clicked that I said to her, you can do everything you told me you want to do, but but start this, even if you need to wait a year or two, you're still so young. And then you'll have all that money available for you. So, and the other point for that I wanted to mention, a lot of us, I know I've talked to so many investors because I'm in that space. They understand OPM. They understand it so much. Leverage, everybody wants to leverage. So they understand that. So that you don't, it's clicks. Oh, wow, that makes sense to me. So much makes
Yeah,
sense.
that this is a great strategy for investors. And
Oh,
you're also talking to a lot of real estate investors too, Deb. So tell us a little bit about, yeah, just what your experience has been
mhm.
with that.
Absolutely. So I have some investors come to me and they're they want to invest, but they don't have enough upfront. So they want to get this going to build it so they can attain their goals and start an investment with real estate um, in the near future.
Mhm.
So the more that they are able to come in, whether it be a lump sum or just a minimum monthly amount, it doesn't matter. Getting it started is the key thing because biggest thing with compound interest is time. When you
Yeah,
allow it time, it will do its thing
yeah, you're right.
with without a shadow of a doubt. You just need to give it time. Some people not as they don't have as much time, so you'd want to put in a little bit more to make sure that you maximize your goals, so that you have that for your future. And if legacy is important, to use that for legacy for your kids, your grandkids. It can go from generation to generation. Literally.
Yeah.
Yeah, I cannot emphasize more. The first thing is like start. Just start.
Well, and
Every more, start.
yeah, and with that, I would say too that the insurance that we're talking about is permanent insurance.
Hmm.
And I think all of us know people whose health situation has changed
Oh yeah.
over time, unsuspected diagnoses of a variety of different things.
Mhm.
And this is one of the things I've even noticed with children's policies, the parents now getting their children started, oftentimes not oftentimes, but teenagers go through a really rocky time emotionally with all those hormones. They don't always qualify for a life insurance policy in their teen years if there's any depression or sometimes with autism issues or even others. I mean, uh, there's a multitude of things. And that's another reason why starting a policy for your children younger is really vitally important before some of these things start manifesting themselves. Would you agree?
Yes, absolutely. And it helps by starting with your kids when they are younger, it helps educate them on paying
Absolutely.
themselves first, and they can attain their goals much quicker.
Oh,
They
yeah.
would have the availability to retire much quicker than you would. And that's what we all want for our families, for them to have a better life than we have.
Mm-hmm.
To, better opportunities, better growth. That's what all moms want.
Yeah. Well, and the other part with that too is I was just talking to a mom the other day, and she was saying how she's getting her kids to get those 529 plans started for their children for future education. I know in my own family that not all my kids are going down that higher education path in a traditional school setting. They're all pursuing education, but it looks different now.
Mm-hmm. Absolutely.
And so 529 plans I mean, sure, we want our kids to have those options of where they want to go to school or where they want to have further education for a skill set of a variety of ways. But this is where starting your child with a life insurance based savings plan, that could be what it's used for
Yeah.
at that point in time, as well as other investments even later on as they start having a career of their own, contributing to it, increasing their contributions. It gives them a launching pad
Oh,
for other
yes.
things.
It's already there. So it's gonna be easier to actually, jump on the wagon and just take it to the next level. That's it.
Well,
It's
and
amazing.
we know people whose health has changed, and if you have a term policy, uh, then and maybe you can explain a little bit about just the differences with the three major types of life insurance. You have your term, you have the whole life, and then you have the indexed universal life. Perhaps, Deb, because you've been in the industry even longer than we have seen, and you touched on this a little bit at the beginning, just how insurance has evolved. Maybe you can touch on that as well, of where those play a role. Um,
Absolutely. And term insurance, it definitely has a place. And if you can get it through work, it is cheaper because you will have, if tragedy happened, there's that death benefit that pays out. You're not going to have to do that. Where the GoFundMe page, the anything like that. But with small kids, I feel that term is really good, but then do a portion. Remember what I said, that with this, we don't focus on the death benefit, we focus on the growth. So we buy the minimum amount of life insurance for the maximum amount going towards your future. So the index universal life is permanent, as well as a whole life insurance is permanent. So they're projected to last as long as you do. You live to 120, that's okay. The whole life, we have found the growth is not as great as an index universal life can do for you. So you have the potential with an index universal life getting to your goals much quicker. Um, the index universal life as well as the whole life, they have the life insurance. They're both protected with tax-free income. You have the security against market losses. With you have extra benefits with critical, chronic, and terminal illness. So if you were in your 80s or 90s and you had cancer that gave you 3 years to live, you could get access to a portion of your death benefit. So all of those features come with the Index Universal Life when you're putting it together properly. Not all insurance agents put it together properly, in my opinion. We're educated to, when I first got in the industry, they educated me to, no, do it this way, do it so you get paid more commission. That's not what it's about. It's about the client, what we can do for them. And then yes, we do get paid a commission, but I want to do what's right for my client. I don't want to get them a whole lot of insurance with a permanent insurance just to have them have less cash value
Yes.
growing in their policy. So I want to maximize what they have so they can attain their goals. I love doing reviews with my clients. They come back to me, and it is an exciting part working with clients, because they'll come back and say, wow, Deb, it's just like you said. Time, it will happen. You just got to get there. So I have many people, when they want to up their contributions, they want to do different things with this. Oh, you know what? I'm ready to buy real estate now. It just opens up that the possibilities. But every life insurance has its place. So depending on what your goals are, term may be the best, a portion term, a portion index universal life. If your goal is just death benefit, maybe whole life is a good option. So it just depends on what your goals are, as far as what would be the best for you.
Yeah, that's fantastic, Deb. I was going to say with that as well, like Deb was mentioning, that it's really good to have another set of eyes. If you already have an insurance plan, let's find out what this really is, what it does for you, how to structure it correctly, why that's so crucial to the insurance policy of the structuring correctly, maximum funded, meaning and I found this out in my first index universal life policy, that I was completely underfunding it, that I could contribute far more than I was. And as a result, that makes your cash value, like you said, it makes the cash value grow slowly when you have a lot of insurance and not a lot of money going towards your monthly payment. So it's really worth a review. All of us are happy to set up appointments with you to do those reviews. And it's like, and even auto insurance, like insurance in general, you have to keep reviewing, what do I have, what does it do for me, even homeowners insurance, so that because your house appreciates in value, if you've got if you took out your policy a few years ago, perhaps it's not going to cover your house now if something should happen to it. So that's another reason why we love educating people, to say, let's just take a look at what you have. Let's confirm that this is the best policy for you, that your contribution is working the best it can for you. And if not, let's look at how we could maximize what you're doing, right?
Absolutely.
100%, yes, without a doubt. You want to maximize. You want to win, not don't let your agent win. You want to win.
And also, we do find a lot of people just say, I've got this policy, and that's about as far as the conversation goes. Right? Because they really aren't sure how much death benefit they have. They're really not sure if it's as efficient as it could be. They know how much they're paying a month, but they don't know what else is happening.
Absolutely. So we, the same way with when you're with your 401k, people are not aware. They give 100% of the responsibility on the person that's offering them the product, where that may not be a best option for you. We want you to get involved. Have webinars where you can get involved and learn more. So we're educating all the time, which is awesome, because, as I said earlier, things evolve, and you want to make sure that you're on the right track for what your goals are. And when your goals change, that's okay. We can change your path. We can work on your path.
Yes.
There's options there that will help you get to where you're going. but again, the main thing is time.
Yeah.
Ran into, I love it when I have young people. So a couple of 22-year-olds last week, and I love it. I
know.
For the passion that young people have. Some young people that they want to get to their goals quicker. They want to. It just excites me.
Yeah.
Well, I was going to say, I liken it to now if we're ever going to drive anywhere that we haven't been before, the first thing we want to do is put that address in the GPS, and then it gives us options. Do you want the fastest way? Do you want to avoid toll roads? Those different options. And I said, I just never really realized how important that kind of map is when it comes to money and our finances. And there are always things. If any of you have been on a road trip, you know that there are some roads that are closed. I ended up spending the night in my car once with 7 of my kids because I didn't take that road sign seriously when it said road closes at this time and won't reopen until 7 a.m. And I saw cars coming in the other direction. And I thought, well, I don't know, maybe it's not that. And so I just didn't trust I didn't trust the signage. And that's why I just always going over where am I now? Is it where I thought I was going to be when I first put this into place? And what are my options? I even had and I've done that with other things. I had another insurance policy with a funeral home. They sell the,
Yep.
like, pick out your coffin today kind of thing. And now that I have put another option into place, but I still had to say, okay, now what exactly does this cover? And if I cancel this, what exactly happens? And if I keep it at this point but don't contribute, what are my options in that scenario? And again, it's like anything else. There's a lot more options once we really take the time to know what it is that we have. Uh, and that's where, like, Mary and I and Deb are so passionate about people really understanding what's their current situation, what are they contributing now, what's it doing for you, what are your goals in the future, and is what you're doing going to take you where you want to go. And I would say oftentimes people are so focused on the contribution aspect that where is this really taking me isn't necessarily a part of that equation that they're aware of, right?
Education is key, and continuing education is key as well.
Yeah.
But I mean, without a doubt.
Yeah. Yes.
Because it's keep evolving, as we said. It changes, and you want to know what's new. How can you do better? Sure.
Well, and that's where we're really passionate about women taking ownership for understanding their financial situation, whether they're single, whether they have a partner, that really understanding where they are, the two of them, and that we also advocate that even if your your partner has a retirement plan in place, putting all your money just in that retirement plan without having one for yourself is not the ideal situation to be in either, because we just don't know what the future holds, or if your life insurance is with your company, that's also, it puts you in a precarious situation as well.
Yes, 100%, because
All
that
right.
is a term, and it ends when your service ends with that company.
And you're always getting older, which means that getting any life insurance becomes more expensive the older that you are, too.
And the
So,
balance of your health. Can you get the life insurance?
yes.
That's why we always recommend to
Start young when
compound
you're healthy.
your wealth as well as your health.
Yeah,
Yes.
absolutely.
Because without your health, what do you have?
My opinion, nothing really.
Yeah. And yeah, so let's just recap. I love what Deb has emphasized this whole time is pay yourself first, no matter what, because your future self will thank you that you started today.
Mhm.
We always hope that next year will be better, but if we wait for the next better year, that could be 3 years down the road, 5 years. It's just going to be the struggle bus. So just get in the habit of paying yourself first, starting today, and then that doing that is helping you to establish a strong foundation for future opportunities in investing. um, you you'll have nothing to work with if you don't start today. So that's where we are huge advocates of looking into an index universal life policy to have your money working for you in multiple ways, especially if you are considering or currently are a real estate investor. This is something really important for you to look into. If you already have some life insurance, it's time to really understand what you have and either go back to the person that sold that policy to you and say, tell me more about what I have. What am I working towards? What can I contribute each year? Am I contributing that maximum amount for what I have set up for myself? Also see, do I have any cash value in there? Sometimes people aren't even aware that it's a cash value life insurance policy that they have. And then if you have questions, we would love you to reach out to either any one of the three of us as well. And we'd be happy to just do a review of what you have. What are your financial goals? And then see if you're on course for reaching your financial goals. Are there any adjustments that might be needed along the way? Maybe you and your spouse have policies already, but you're thinking, oh, that would be a good idea to start my kids. Again, we would love to have a conversation with you about that. So, Deb, where could they reach you to ask you more questions?
Okay, so it would be calendly.com/rise with MPI.
Great. Great. And Miri and I, you can just message us through our social media, whether on Instagram or Facebook. Our name, Carolyn Blazo and Miri Cordaro. Any last words, Miri?
No, I mean, I think the most important is to start. That's the way I look at it. You start, and then you can, then you we help you to stay there. You know, just encourage you that is going to be all worth it, really, truly. So,
Yeah.
Mhm.
Thank you for joining us today, Deb.
yeah, thank you.
And it's always great working with you. I always look to Deb too, and I've got
Of
challenging
course,
cases. I love her wealth of experience, and she's been in the industry even longer than we have. But we continue to stay passionate in educating others.
great day.
Have a great day,
Great day, and pay your
Bye.
first.
and
Thank
pay
you.
yourself first.